Hello there, Prof. Aram here, and in this video we are going to go over the ingredients that we need to calculate the weighted average cost of capital for the firm. And the first one we are going to look at is the cost of equity. So let's get to this. The cost of equity is the return required by the equity investors or common shareholders of the firm given the risk of the cash flows from the firm. We have two types of risk in any firm. A risk that is inherent in the business of the company. So as if the company was all equity, it would only have business risk. But if you add debt to the capital structure of the firm, you're going to add some additional risk, some financial risk on top of this business risk. And there are two major methods to calculate this cost of equity or required return on equity for the firm. One of them, we've already seen this in the stock valuation chapter, and that's the dividend growth model. So you can calculate the rate of return on the equity, which is dividend in year one over price today, plus the capital gain yield or the growth rate of the dividends. Or we can use the security market line or CAPM that we learned in the risk return chapter. So in that case, the required rate of return for the stock is going to be the risk-free rate plus the market risk premium times the beta of the company. So let's look at the first one. In the dividend growth model, we start with dividend yield and then add the capital gain yield to calculate the rate of return on the equity. As an example, suppose your company is expected to pay a dividend of $1.50 per share next year. So this will be your D1. And there has been a steady growth in the dividends of 5.1% per year. So this is your growth rate. And then the current price, P0, is 25. The cost of equity in this case is going to be D1 over P0 plus the growth rate, or dividend yield plus the capital gain yield, which is going to be 11.1% for this firm. If you don't have the growth rate, you can look at the dividends that have been paid in the past and then calculate the rate of the percentage change in dividends each year. So for example, for 2015, you do ending minus beginning dividend divided by beginning, which is ending minus beginning divided by beginning, 5.7%. And we do this for every year. And then at the end, we take the average of these percentage change in dividends to get the average growth rate for the firm. Another way to calculate this growth rate is to multiply the ROE of the firm by the retention ratio. In other words, how much of the earnings are retained in the firm for the sake of growth. And then you multiply that by the return on equity for the firm to get the growth rate of dividends. The advantage of this method is that it's easy to understand and use, but the disadvantages are more, meaning that it's only applicable to companies that are currently paying dividends. There are a lot of firms that don't pay dividends, and it's not applicable to firms that their dividends are not growing at a reasonably constant. So if your dividends are high in one year and low in the other year, you can't really use this constant growth formula. And then it's extremely sensitive to the estimated growth rate. So if you're not doing a good job in estimating your growth rate of the dividends, then your estimate of the cost of equity is going to be inaccurate. And then it does not explicitly consider risk. Here we mean systematic risk of the firm. So that leads us to the second method of calculation of the cost of equity, and that's the security market line or capital asset pricing model approach. So in this case, we use the CAPM or SML formula to calculate the rate of return on the equity, which is risk-free rate. This is the base rate that we expect to receive from any investment, whether it's bonds or stocks or real estate. Risk-free rate is your base. And then we're going to add a risk premium. So this risk premium is a multiplication of the systematic risk of the firm times the market risk premium. So this is basically the same for every firm. We call this the cost of risk in the economy, and then we call the beta quantity of risk for that particular firm. And then again, you can basically look up beta of the firm for any firm that you're looking at evaluating in Yahoo Finance or Bloomberg Terminal, or there are a lot of vendors that provide these beta estimates. But you can calculate it yourself too. If you have the, let's say, average monthly returns for a stock for the past 5 years, and then you also have the average monthly return for S&P 500 over the past 5 years, you can easily calculate the beta yourself, which is the covariance of the return of the stock with the market divided by the variance of the market. How can we calculate this? How can we use CAPM to calculate the cost of equity? Here's an example. Suppose your company has an equity beta of 0.58. So market beta, or the systematic rate of the market, is usually 1. So if the beta of the firm is less than 1, it has less systematic risk, even less than the market. And if it was more than 1, the systematic risk was more than the 1 for the market. And the current risk-free rate, so this is your beta, current risk-free rate is 6.1, and the market risk premium is 8.6%. So this is the market risk premium. So when you have this, I see sometimes that the students, when they want to calculate the CAPM, they do 8.6 minus 6.1, but that's not right, because 8.6 is the market risk premium. That means that you've already subtracted the risk-free rate from market return to come up with this number. So you should not subtract risk-free rate again. That's why here we have risk-free rate plus the beta times the market risk premium, just one number. You don't do minus risk-free rate again. That would give us 11.1%. So since our rate of return using the CAPM is similar to the one that we found in the dividend growth model, we could feel good about our estimates and use 11.1% for our cost of equity, for an estimate of the cost of equity. The advantages and disadvantages of security market line and CAPM approach is that they explicitly adjust for systematic risk, which is a good thing because we use beta of the firm here. And it's applicable to all companies as long as you have access to historical information to estimate beta for the firm. But the disadvantages are you have to estimate the expected market risk premium, which varies over time. So it's a lot of work. Have to estimate the beta, which varies over time also. And then we are using historical data to predict future, which is not always reliable. So here is an example again. Suppose our company has a beta of 1.5, the market risk premium is 9, and the current risk-free rate is 6. And then you also know that the growth rate for dividends are 6%, and the last dividend, D0, was 2. If the price is $15.65 today, what is our cost of equity? So we can do CAPM, which is risk-free rate plus 1.5 times the market risk premium. And then we can use the dividend growth model. So keep in mind here you have D0, the dividend in the past, so you need to calculate, you need to use this formula to calculate basically D1. This is D1. Okay, the whole thing is D1. So again, we come up with a estimates of the cost of equity that are very close to each other, so we can feel comfortable about our estimates. So of course, I mean, we're choosing the inputs in a way that make it work, but later on in other examples, we see that this is not happening all the time. Sometimes one estimate is closer to the true cost of equity than the other. I hope you find this video useful, and thank you for watching.